back to Morning Trade Live. Let's keep talking some earnings and a couple big sell-offs here. One of them in Warner Bros. Discovery, home HBO Max, down double digits. We've got Disney coming out. Let's talk some streaming, do some trading. Got Tom White here with me in the studio, and Paul McCarthy joins us from Kisco Capital, president, with some thoughts on the stocks. Let's start with what we've got, Paul, with Discovery down 15%, almost down to year lows. Where's the pain coming from here? Can we chalk any of this up to the strikes and the labor stuff?
I mean, if you look at their revenues, they had, a bump in theatrical and gaming. They had Barbie, so they got the Barbie bump this last quarter. They're not obviously getting it today in the marketplace. But, when you look at earnings, worse than expected, but they are generating free cash flow. And that's sort of the good news here is that, since the merger, they've paid down about $12 billion in debt. I was on the call this morning, and the CEO was, saying that they're very dedicated to driving free cash flow and paying down debt. And so this company it's got a lot of debt. It's got $45 billion in debt. It's hard, I think, to project out what revenues are going to be next year on gaming and theatrical. They did take a hit in revenue from TV due to the strike, and they think that'll rebound some. We do have an election year next year, so that might help CNN, I suppose, with ratings. But, it's just a company that's got a lot of debt. And so I think that the company, the management's executing. They are on track to do about $5 billion in free cash flow, which I think is a really good number for them. And I think that if they can continue to, do that over the next year, that might give investors a little bit more confidence in the stock. But for now, I'd say that they're doing a pretty good job executing on generating cash flow and paying down debt. But they probably need to continue that going over the next year, where debt levels, maybe they'll drop another $10 or $15 billion and look a bit manageable. But despite the reaction today, I mean, the stock is just not traded well for some time now. And I think that, if they can go another 3 or 4 quarters of good cash flow, that would sort of lend a more positive aspect. So, but the question is this a value trap or a value play at this point? So, but for me, it's something that kind of like more like just sit on the sidelines right now. So, and the one other good thing to mention is that the duration on their debt is about 15 years, and their coupon is 4.7%. So not too big of a refi risk in the near term, but over the next 3 years, they will start to have about a third of their debt come due. So I think that they're focused on the right thing right now, but maybe till sometime next year until we get a clearer picture on exactly what the company's going to look like post-merger.
Yeah, losing more money than expected in the meantime definitely doesn't help. So, I mean, this is not like a solvency risk issue, the onerous nature of the debt, or do they really need to start pumping up free cash flows? Is there any obvious place that comes from?
Well, they did take on floating rate debt with the merger. They've paid most, if not all, that off. So that's good, because that would be their higher coupon debt. I think that they've, sort of integrated. I think they just need to work on subscribers. I think that they talked about, doing some price increases. They talked about getting better content on HBO so that they reduce their churn. They say that churn also increases their marketing costs. So that's something that they're going to be focusing on. They said that the one area that they haven't really tackled too well is sort of like the kids area. So that's something that they're going to be looking at as well. But I think that they're pretty much just going to be working on, basically the assets they have and just trying to get, more cash flow out of it. And so it goes to a question as to the streaming area. They made a little bit of money from it this year, but it seems like it's harder to make money in that area, and sort of like, how much of it is the future and linear. And the CEO said on the call that they haven't thrown in the towel on linear. And I think that, linear can improve down the road, but the streaming area is very competitive. And so they do have some good assets, to work from, but, it's more or less taking what they have as opposed to acquiring anything. So it seems as though they've been doing as good a job as they can on that for now. So they had last quarter, they generated $1.7 billion in free cash flow. This quarter, they did $2 billion. So they improved from that. Maybe that's because the Barbie property did so well. So, you want to see probably 4 or 5 quarters of, good cash flow generation, but they think they can do about $5 billion a year and retire debt on the way. It does kind of hamstring them on acquisitions of like content because they need to get their debt down because like I said, 3 years from now, they're going to have some debt to refinance at least anyway. So, but it's definitely out there. But if they had more debt due in the next year or two, I think it'd be more of a solvency risk. But I think for now, it's in the okay category. It's like I said, the stock's down 15% today for a reason. I guess they wanted more good news out of it. Maybe they thought Barbie would be even a bigger bump. It's kind of the management's doing a good job, but it's a really tough stock to trade or own right now.
What do you think when you look at the chart and the options, Atomic? Because I mean, fundamentally, to Paul's point here, this is a pretty, it's kind of a drag. Yeah. This is just, there's not a lot of big new growth. It's just wringing out profits from what they got, trying to pay down debt slowly and surely.
Yeah, I think if you look at this from the options market, there's not a lot of extrinsic or option premium value in any of the options that are around this. Now, if you think this 14% pullback is a buying opportunity, you can buy the shares, right? Got to outlay some capital for a $10 stock, basically. But I looked at something different using the option market, but giving myself some duration. I went out to the January monthly cycle here for an example. Instead of buying the stock, hey, let's define our risk, and it's going to be a lot lower than the stock. Now, you also have limited amount of duration also. I went out to the January cycle, bought the 7.5 strike call. This is about a 90 delta call. So it's, for every dollar that the stock moves, this call will move 90 cents. So it's almost equivalent to the stock. 7.5 strike, deep in the money. You're paying roughly about $2.70 debit for that call. There's going to be your risk. Instead of buying shares, it'll cost you maybe $1,000 for 100 shares. You buy one call. It's going to cost you $270 in risk. Now, you see your break even there at $10.20. That's 25 cents above the current share price in there. So there's your extrinsic value, only 25 cents. And you've got 72 days until expiration. So if you expect a rebound, over the next 2.5 months, this might be the way to play it as opposed to buying the shares. But it does limit your duration. That break even is only about 2% above the current share price in there. And you're not paying a lot of extrinsic value or option premium to buy this deep in the money call.
Okay.
Stock replacement type strategy.
All right. And the 7.5 strike, right, that you're going for?
Yeah.
Okay. Nice. So as long as it doesn't break through 1-year lows and then some.
Yeah.
All right. Okay. Makes sense.
And you're defining your risk. What you pay is your risk on this trade.
Yeah. All right. I like it actually, because at least right now we're still $1.50 or a little bit over $1 away from the 52-week lows. So it's not like there's not a chance for support still.
Right.
Maybe down there somewhere. Where's the support in Disney, Paul? $78, $80, kind of bounced off there a few times. Earnings coming out after the bell, but again, it seems like if you are not Netflix, then your streaming business has been more of a drag than a boon.
Yeah, I mean, just looking at the segment of streaming for Disney, they lost $1.5 billion. Then last quarter it was $500 million, and so they've made an improvement. So I think after the call today, the markets want to see is that how much is that dragging on their cash flow, and it's a very competitive area, so it's been harder to, drive money to the bottom line. For the Disney chart, like you mentioned, it's sitting right on this support level. It's trading, Disney's trading at 2014 levels. I tend to think some of the uncertainty of the stock was just that, Iger left and now he's back. They have a new CFO from Pepsi. The question, he's got 2 more years in his contract. So what's the future if he leaves again? And who's going to lead the company? Because things just unfurled after he left. So that's a big sort of long-term question, for the company. But, they're planning on from what I read, spinning out ESPN in 2025. There's a pretty good buzz around that. I think, there'll be a lot of subscribers to that as a streaming product. So they're trying to get sort of their cost structure down. They've been getting that more in line too with Iger. But, there's question as to, I think, the quarter will probably be, I think, fine, after the close, but, sort of prospectively, who's going to lead the company and what's the strategy? The Hulu sale is also going to be discussed. They're buying the remaining third from Comcast. And they have about 100, and from what I can tell, about 170 million subscribers across all their properties. So what are they going to do with all this stuff, and how are they going to monetize it, I think, is going to be a big question for the earnings call today. And it's right on sort of the support level, $78, $80. If you lose that, there could be some downside acceleration. So it's sort of, again, sort of a wait and see on this streaming business.
This is very much now the seed time. It feels like we've been waiting. And since Bob Iger's return hasn't gone much better, so maybe the market needs some needs a little proof that this has been the right call. Thanks, Paul, for the thoughts. Tom, we got a quick trade here. Disney had the report.
Really cheap, inexpensive way to play this if you think it's going to move. Option market's pricing about plus or minus 6%, $5.